Hello everyone and welcome to today's major markets update for Friday the 23rd. It is Friday, so we're going to have the weekend before we continue next week into more blood on the street. It certainly looks that way. The preferred view was for looking lower, even if we might expect this rare irregular, potentially flat B wave that I pointed out as a potential path that is still in the markets. But for now, lower it is. We've reached a 100% Fibonacci extension, so today's close wasn't too surprising. But before you even get there, please remember Jesse Livermore's 21 trading rules. If it's not right between the ears, whatever I say is not gonna be perceived well, and your trading is not going to go well. All right, you got to have the right expectations, and of course, because that will lead then to a better trading, because otherwise you overpromise and underdeliver. So I cannot be all the time right. I'm just interpreting the charts to the best of my knowledge. I provide you with alternative views that can be used as a forewarned is forearmed type of setup. So you know where a certain position might be wrong and that the direction of the market is changing. Here are many ways you can use me to your advantage. Please do so. Watch the how-to videos. Sign up for my trading alerts. It's up 50-60% for the year, depending on how you kind of would trade it. So there is lots of ways to make money. That said, let's go to the charts and start off with the mother of all indexes, the Dow Jones, because she's been around the longest. This is the expanding leading diagonal A wave, as you can see here, and we are now in wave 5 of A, all the way down to about 25,000 on the Dow Jones. So we got some little ways to go. We're about 29,500. So most of the downside has, of course, already been done. The August high was a fourth wave bounce, and we're now impulsing lower and potentially have completed wave 3 of 3. As you can see, we've reached exactly the 100% extension of wave 1, measured from the high of wave 2, which was the mid-September bounce. And then this was the Friday, I believe it was, where Powell screwed us all. And why do we bounce here at the 100% extension? Because based on this is Avi Gilbert's Fibonacci pinball work, wave 3 of 3 should bottom, or in this case bottom or top here, at the 100% to 123.6% extension of wave 1 measured from wave 2. So that is exactly what we got. So we might be potential wave 4, and then we get wave 5. Okay, so wave 3 can still go a little bit lower to about 29,000, and then a wave 4. But the pressure remains to the downside. I have no signs of letting up whatsoever. There's no positive divergence anywhere. Things are all pointing down. Down is the preferred path, unless we break pretty much back above 30,500 on the Dow. That is, I would say, the bearish cutoff. And let me put that in here for you. That should be about there. So 30,516 bearish cutoff. Okay, that is the bearish cutoff. Why? Because then we start to overlap with this potential wave 1 bearish cutoff, and we don't want that. If that's the case, then any short should be exited, because I'll show you what then could happen. And then what could happen is this, that we have completed wave C of B for this larger A, B, C flat of a larger B wave. Okay, so this potential is still there, because so far, as I said, we bottomed right here as C is A. So this is fully possible, and we should not take it out of consideration. So again, taking profits, raising stops, all those things should never be not done once certain Fibonacci levels are reached. But as you can see, here are the vertical lines showing what happened year to date, pretty much with the Dow Jones when it got this oversold. Okay, so I want to kind of compare apples to apples. If this is indeed a new bear market, we cannot compare it with the previous bull markets, because these are different market environments and the market responds differently. We're well below the 200-day, well below the moving averages, well below the cloud. When that happens, prefer to look lower. Anyway, so the RSI 5 here on the daily time frame is at 13. When we get this low, we should see a bounce for the lower. So bounce for the lower. Here we kind of went immediately lower. So we have 1, 2, 3, 4, maybe even 5 types of setups where it all looks for a potential bounce and then lower. And after that, we might see a bigger bounce and then lower again. That would be, of course, the 3, 4 is the bounce, lower is 5 of 3, 4 and 5. Doesn't have to fill in this way. This is our ideal Fibonacci-based path, and the market reserves the right to not fill this path in exactly to the T. As long as wave 1 and 4 do not overlap, and wave 3 is not the shortest wave, we can, of course, use other Fibonacci extensions. So please keep that in mind. It doesn't have to always be exactly Fibonacci pinball, according to what we see here. But this is the general path we look for in the markets. That's what we anticipate, and then we monitor for it and we adjust accordingly if necessary. So again, we now have completed this CSA relationship. So the market has left the door open for this. Whatever happens over this weekend, maybe the market decides to do something else and completely opens up 1,000 points on the Dow Jones. Very possible, very possible. So that's just an option. I'm not saying it's going to happen. That's the option that's in the charts that I'm seeing and conveying to you. Similar here to the NASDAQ 100, hasn't reached its full CSA downside target, which pretty much is exactly at the June low. Then we get A, B, C, Alt A, Alt B, Alt C. That's the alternative count. If not, we simply keep impulsing lower and start looking for these downside target zones based on Fibonacci extensions for third, fourth, and fifth waves to be reached. As you can see here, 5 of 3/C nails exactly the third wave target zone. So the pressure remains to the downside. The door has been opened once we broke below, I think on the S&P 500 was 38.86. The market went through the door, and so far it keeps moving away from the door further and further. The pressure remains to the downside. Everything is pointing down. Everything, every single indicator is pointing down. There's no positive divergence other than maybe on the MACD, but it needs a reversal pretty much on Monday to start to confirm it. And divergences are only divergences till they're not. They are a condition, not necessarily a trigger. Semiconductors. As you know, I am 70% of the time right. That's all any analyst pretty much can give you. So maybe 80% if you can really squeeze it out. But this is what I was tracking for the semiconductors. A 1, 2, 3, 4, 5 to the downside. 3 was reached, 4 was reached, 5 was reached, but we fell through it. And this is where your 70% comes from. Okay, this is here you get 3 out of 4 correct, pretty much. All right, correct, 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 not correct. It happens. So we went below this July low. What does it mean? It means this July low was, of course, not an important low as a question mark 4, and this is not a regular expanded flat anymore. We anticipate, we monitor, and adjust. Okay, so I anticipated these 5 waves lower. Bingo, bingo, bingo. My name is Bingo, but here I missed it. I'm sorry, it happens. Nobody gets it right all the time. This is why you also have stops in place. It's okay to go long here. I actually personally went long semiconductors based on my Elliott wave count, and then I actually decided to sell it just before the Federal Reserve meeting because I was like, you know what, it's all volatility, let's just get out. That was just my point of view, and I made a little bit of money on it. So be it, but that's how I went about. And now we see that we have further downside ahead, because this is not a regular expanded flat anymore. This is, in my humble opinion, better adjusted to a B wave low here in July. So the A wave bottomed here in June, just like it did for the Dow Jones. And we instead for the semiconductors had an irregular B wave. You see this? Irregular. It went below the June low. Clearly 3 waves up, A, B, C. Clearly 3 waves lower, A, B, C. And then clearly this remains 5 waves higher. Okay, so this was correct assessment, 5 waves higher. That was correct assessment. So after 5 waves up, one should expect 3 waves lower. And those 3 waves lower should not go below the start of the beginning of those 5 waves up. They did. That means those 5 waves up are a C wave of, in this case, a regular, irregular, expanded flat B wave, A, B, C. B waves are corrective patterns. They are either zigzags, flats, or triangles. In this case, my initial assessment was wrong, and I had to readjust, going all the way back to the June low and reassess it as an A, B, C. And this is what I mean with you cannot get it right all the time. You see, you miss one interpretation, but eventually you adjust it accordingly. So shorter term, this went all great. Uptrend went all great. Everything went well. But now this little candle today tells me what I had originally was wrong. And one can only become better and be right next time by admitting that one had it wrong since June. Everything was, the whole bigger picture. So the bigger picture has been adjusted. So now I'm continuing to look lower. Things look still very leaky. So to say, it looks like it's lower. We broke below support. Doesn't look good. So I'm looking lower here for another 5th wave. Excuse me, I had to have a little water. Here is the S&P 500s with the expanding leading diagonal wave A, either primary or major to be determined. And the bearish cutoff is now, of course, at the low made before that Federal Reserve Day on Tuesday, which is at about 38.20. That is our cutoff. If from current levels we go above 38.20, then we, of course, can start to look for this alternative option. Okay, this alternative option. For now, I prefer this path. 3, 4, 5. Well, 5 might bottom a little bit shy. 3 might be a little bit shy. So this is the ideal Fibonacci-based path. Doesn't have to be this way as long as 3 is not the shortest wave and 4 doesn't overlap with 1. We don't have to get it ideal. Okay, that's the same I can show you for the NASDAQ 100. The ideal wave 5 here in green target zone was here. We didn't reach it. Okay, the 4th wave was reached, the 3rd wave was almost reached. We didn't reach it, so it doesn't have to, but we went below wave 3, and that's all a 3rd wave needs to do. So please, a 5th wave needs to do. So please keep that in mind. So this is the path I'm tracking. That leads us to about 3,300, all right, plus or minus 50. That remains the preferred path once we broke below the lows of 38.86. And lower it is. I see no reason to change my tune. This looks like it's accelerating to the downside. There's no positive divergences, no nothing. So far, this could be just a short covering into the close, as some people might call it. I call it a wave. That's what it is. So looking lower, this is the ideal path, and we'll just have to simply see how this is going to fill itself in. Alternatively, again, we need to break above the bearish cutoff from current levels to suggest we have the A, the B, and the C wave. Way too early to tell, but this path still remains possible, okay, though less likely. The more lower we go, the less likely it is, but it is certainly possible. So I want to reiterate it a gazillion times. Similarly, for the IWM or the Russell 2000, I already said if we would break below, I believe it was 177, we should target 170 plus or minus 2, and this is where we are. No surprises. And note also here we have a potential C is A relationship, the red arrow, C is A. So also here we can have this potential. Okay, I'll do it in red there. Okay, this is still possible. This is still possible. If not, and we just keep leaking lower, then we get, of course, wave C. So let me make that one in black. So that is, of course, the alternative. With the bearish cutoff, of course, here at about 177. That is, or 176.5. That is the bearish cutoff. We don't want to see price move back above it because then we don't have an impulse lower anymore. And we need to look at, this option. All right, that we have this more complex B wave. There, we keep leaking lower, then we simply have an impulse on our hands, and I'll be looking into the 160s to 150s, more like the 155 plus or minus 5. Okay, so those are really the two options I'm looking for. I know that the Dow Jones has 3 options, but it's pretty much a little bit potato on the August high being a B wave versus a 4th wave. As I stated before, there will be ramifications on if it's a 4th wave or a B wave high. If it's a 4th wave high, the counter trend rally, blue wave B, can only retrace around 50 to 62%. Will probably bring us back to the 33,000s on the Dow Jones. If we get 3 waves lower for wave A, wave B can challenge the all-time highs, because then we can do a flat. Remember, for Tesla, I said we had a flat wave 4, and that we then had wave A was a flat, other wave A was a flat, 4 was a flat. So a flat within a flat within a flat. And that can currently happen as well. I don't know yet how this is really going to be interpreted. We'll see eventually a no, but of course, once this wave A completes, a bigger counter trend rally must be anticipated, either 50-62% retrace or a 90+% retrace. But I think once you get to the 50-62% retrace, it's time to start raising some cash. But we're not there at all. We're still trying to figure out if we get this 3, 4, and 5 to the downside. Okay, that is really big picture thinking on how this larger B wave bounce is going to transpire, depending on how you interpret this price action, either as a leading diagonal, then you get a shallow retrace, or as a 3 wave, and then you can get a bigger retrace. So that brings us back to the IWM. So please know your time frame as well, and which time frames I'm talking about. Shorter term, very close here to invalidating a potential A, B, C path. It's still possible, but we can, of course, trickle lower through the impulse path, as shown here, on all indexes. That remains the preferred path. Once then the larger A wave completes, we will look at some other options, but we're not there yet. Let's have a look at market breadth. Okay, so this is the NASDAQ composite bullish percent index, and at the mid-August high, we only got as high as 52%. That's not a kickoff wave. All right, kickoff waves is where the bullish percent index goes above 70%. Okay, as you can see here, big strong moves. This is not a kickoff wave, this is more of a bounce. And I think we can see the same here for the Dow Jones was a little bit higher, but it has fewer components. Then NYA shows you not a kickoff wave. Compare that where we were here in 2020. Those are kickoff wave. We only got to about 60%, and we're once again down below 20. So clearly that was just a bounce. And of course, we're trickling a lot lower on the NYA as well. And here is the S&P 500, definitely stronger as well, but again, not as strong as we usually see, like here in 2003, or as we see here in 2009, okay, well into the 90s. I want to see well into the 90s. We barely got over 80, so that suggests just a bounce. How are we doing on new lows? The new lows are spiking quite high. We're in the 1,000, okay? That's really, really high, gets too extreme to the upside. Now, we want to compare apples to apples, okay? I don't want to compare at this moment the bull market since 2009 into early 2022. Let's just compare 2022 with 2022. Here are the occasions when we go over 1,000. Slightly more upside left, downside left, okay? Slightly more downside left, and then a bounce, okay? And lower prices. Same here for the NASDAQ 100. So we're getting pretty extreme on the new lows. So expect a marginal lower and then a bounce and lower again. That's pretty much what this chart tells us. How are we doing on the McClellan oscillator of the S&P 500? Okay, 2 days ago, it was at about minus 90 something. Yesterday was minus 113. Today is at minus 131. In the last 10 years, we've only had, let's see here, 1, 2, 3, 4 occasions where it went this low. Anytime we go into this low of a regime on the McClellan oscillator, meaning a lot more indexes or stocks in the index are declining than advancing, you can see most of the time there is further downside ahead. Okay, that's what it suggests. We might see a bounce if we would zoom in, but we probably need to see some positive divergence on the McClellan oscillator developing, meaning lower prices, but with more internal strength. So this is quite a low reading over the last 10 years, hasn't seen that often, but it's not totally unheard of. If I would zoom out even further, let's have a look. What does this compare with? As you can see here, there are a few extremes as well that we haven't even reached yet. Okay, so please be aware that the current McClellan oscillator reading is extreme to the downside. That suggests we might need to take some steam off to the downside, but also that for a good rally to develop, we'll need to see a bounce and then some lower prices with more internal strength for the next bigger bounce. How are we doing on bulls and bears and all that stuff? Well, the money manager exposure was still at 30%. It's slow, but nothing extreme. Maybe next week it will be extremer. And as you know, from yesterday's update, the bull bears were at 60% bears, I believe, and maybe 10 or 20% bulls left. So extreme bearishness out there, but those are all conditions, not triggers. Haven't seen any reversals yet on the price. So we have to wait and see. So internally, this is still way too many lows for a new uptrend, so to say. You know, like we had here in July and August, we want to see it below 50. That's more steady eddy. But once we got the spikes going, and especially today, this is quite extreme. We might see a little bit of further downside, maybe some more selling on Monday before we start to reverse, possibly on turnaround Tuesday. Getting quite oversold on other measures as well, but there's no indication yet that the alternative path has started. We have our bearish cutoff for those, as I've shown you here on the IWM, as I've shown you here on the Dow Jones. And then there's plenty of upside left to enjoy that path versus the downside path. The downside path remains preferred. Again, the semiconductors was wrong. The June-July price action, these 2 weeks, required a different interpretation. Instead of a 3-4-3-4-5, it turned into a 3-4-5 ABC, ABC, and then a 5 up. So here we already had this irregular expanded flat, and we should now be on our way impulsing lower to complete a C wave. Same here for the NASDAQ 100. We should bottom maybe a little bit lower for this alternative A, B, C path. Otherwise, this green path remains in play. Same here for the Dow Jones. Might be front running things a little bit, but please look at the chart. How oversold things are is not necessarily a sign for a bounce or a new rally. I mean, all maybe for a bounce. We're below all the moving averages. This is a 100%, if not 1000% bearish chart. It really is. So I prefer to look lower. This is the detailed Elliott wave count for the ABC and the detailed Elliott wave count for the 1, 2, 3, 4, 5. Okay. So far we've done picture perfect 3, 4 or ABC as well. That's all I have for today. Thank you so much for listening. I hope you appreciate the two main options that I presented. I presented it yesterday for the S&P 500 as well, which is we either continue to the downside in an impulse, or we have completed or very close to completing a very large B wave of a even larger B wave. In that larger B wave here in blue will be a irregular or a regular flat. Could be expanded or regular, could even be failed flat. But this is still the possibility A, B, C. That's the alternative. Preferred 1, 2, 3, 4, 5. Prove me wrong, market. We have our bearish cutoffs in place. Take care, trade safe. See you all on Monday.